for a look at this week's economic data and how it may impact the Fed's inflation battle. Let's bring in Campbell Harvey, professor of finance with Duke University's Fuqua School of Business. Cam, thanks for joining us. Earlier this morning, I credited you with inventing the yield curve, so congratulations. That was a mistake I made.
Thank you.
But you are the person who originated the idea of the yield curve as a recession indicator, and I'd like to ask you to update us on how that's going, or not.
Yeah, so the yield curve has got a record of 8 out of 8 with no false signals going back to the 1960s. It is a leading indicator, and the lead time varies between 6 months and 23 months. We've been inverted since November of 22, and we're about in the 20th month. So again, this is a leading indicator. And I do want to contrast the yield curve inversion indicator with the so-called SOM rule, which is not a leading indicator. It's a lagging indicator. And I think people misunderstand that.
So you're saying you still have 3 months to get this right, if I'm not mistaken?
So not exactly. So historically, the lead time has been 6 months to 23 months. So if it goes 23, 24, 25, I'm not sure, that's just within what could happen. So
I guess my question has always been, Cam, and it's really a pleasure to have you on to talk about this. Does the yield curve, the inversion of the yield curve itself cause the recession? What is the relationship of this inversion to the ensuing recession?
So originally, when I published this idea in the 1980s, so it's been a long time, this indicator would pick up expectations of economic growth. So if you think about interest rates, they contain expected inflation, but also an expected real interest rate, and that's linked to expected real activity. However, recently, the model, I think, has changed, and the yield curve is more causal. So people see an inverted yield curve, it changes their behavior. So as a CEO, when you see an inverted yield curve, you're just less likely to pull the trigger on a bet the farm type of investment in the face of inverted yield curve, which is 8 out of 8. So you don't want to take that risk. So that investment is decreased. Employment, we saw these layoffs, 5-10% of the workforce. So the yield curve now is a causal mechanism. And I believe it has slowed economic growth. And it's a risk management tool.
Cam, I've heard an economist describe this moment when we're going to be cutting interest rates as the most dangerous time. To what extent does that feed into your theory here, in that when interest rates are changing and, say, perhaps about to go down, you actually cause more delay in investment decisions?
Yeah, so uncertainty is bad in general. So uncertainty holds back economic decisions. As for the cut, really what the Fed needs to do is to undo the damage of raising the rate too high. So they've overshot, in my opinion. Indeed, they inverted the yield curve. So you talk about a causal mechanism. They inverted the yield curve and have pushed us towards slower growth. So what they need to do is quickly, and this should have happened far earlier, move the rate down, hopefully substantially, at least 50 basis points in September.
Cam, I'm curious in terms of it becoming a causal indicator at this point, because I was going to ask you, with each passing month, you have to wonder whether or not that 8-for-8 streak is going to be broken. The fact that it's moved to become a causal indicator and has actually altered how people act within the economy and has altered the path of economic growth, could that recession actually be averted at this point?
Yes, hopefully. So actually hope my indicator is wrong. So nobody wants a recession. But I do believe that you're correct, and this is an important insight, that often a popular indicator that does really well, stops working. And I think that what my indicator is doing is people see it, they see the track record, it changes behavior, it actually slows growth, but in the context of risk management, this is really important. So companies are not going to be surprised if a recession starts later this year or early 2025. They're actually ready for it. And what we don't want is a surprise recession where companies have to slash their workforce. As soon as you do that, that makes things worse. It deepens the recession. So think of this indicator as actually slowing economic growth, but leading to a situation where we can have a downturn without like a hard landing. So slower growth rather than something like the global financial crisis, which nobody wants.
Cam, we have to go, but you said 50 in September. How aggressively should the Fed be bringing down interest rates here?
So I will be very disappointed if they don't lower the rates by 50 basis points. Real-time inflation, if you use, let's say, Zillow or Apartment List, is 2% or below already.
Right.
So there's no excuse for not cutting at least 50 basis points. Indeed, they should have delayed the last meeting by 2 days to get that important employment data.
But I know what you're thinking about for September. I mean, over the course of this year or so, how much should they be taking off the funds rate? Where should we be a year from now, in your opinion?
Oh, in the low 3 range. So 3.5.
Wow. So 200 or so off of where we are now.
A little less, yes.